Hey guys, TommyBryson here, and today we're actually going to do a book review on a book that I did not think had this much good information in it, but it actually did, and it actually did surprise me. And it's called One Up on Wall Street by Peter Lynch. Now, if I'm being honest here, guys, it's the first material I read by Peter Lynch because basically I always hear his name from Warren Buffett, also Charlie Munger, but I never actually went out there and read one of his books. Now, this book right here, guys, contains a bunch of valuable information when it comes to how to invest and what to invest into, how to buy, and how do you know exactly when to sell an investment. And more importantly, guys, it's not just one of those books where basically is filled with, hey, here's a figure, a formula here, where you basically can't understand anything, but it's a very simple book to actually understand for a beginner investor. And by the way, if you don't know exactly who Peter Lynch actually is, he's basically an investment manager that used to work at Fidelity and had his own fund, and basically he's really famous because if he had invested 10K in his fund, he would have turned it into $190,000. Yes, that's 190 from a $10,000 investment, and he bought well over 1,000 stocks and made 10 times his profit over and over and over again, with around an average around a 20% return every single year, which is basically a lot more than the Dow Jones and also the S&P 500. And that's why this guy right here is so famous. And here in this video, I'm going to share with you guys 3 things I learned from Peter Lynch in this book and why I also recommend you go ahead and get this book right here. And by the way, if you want to get this book, I actually listen to the book on Audible. So if you want to get this book for free, I have a link down below to Audible. You can go ahead and get this book for free and also another book if you want to. On top of that, even if you cancel, you can actually still keep those 2 free books. So there's no way to lose any money. It's just a free book, free info. Why not? And by the way, I read an Audible book every single morning when I'm actually going to the gym, and that's why I love listening to books while I'm exercising or while I'm doing anything out there. And by the way, if you're new here, guys, I post videos every single day on YouTube, so make sure to also subscribe and hit the bell so you get notified. And on top of that, also destroying the like button. I felt like that intro was literally so long, and I apologize for it. Now, let's get right into the video, guys, okay? And the first thing is this. I was actually very surprised when the entire opening statement of this book was basically, hey, if you want to get into stocks, you kind of have to look at yourself and ask yourself, hey, am I even any good to go ahead and invest into stocks? For example, do I actually own a house? Do I have, for example, enough money that if I lose some money, it doesn't really matter that much? So in reality, every time I hear about investing, usually it's all about, hey, grab some money, invest it. If you lose it, no big deal. But Peter Lynch kind of like, hey, make sure you have a house. It's going to be a very good investment. Make sure you have money on the side, and make sure the money you use to actually invest is not going to be all your savings, and you're not going to go broke if things go left. Because basically, he's very honest when he says this, okay? Investing is very risky. If you do it correctly, you'll have good performance, but still, you can still go wrong, and before you know it, lose everything you actually have. So just make sure you understand that. On top of that, he says do the mirror test. Are you a person that can actually understand the risks, value an investment? On top of that, ignore the panic going on in the stock market. And also, one of the most interesting things I ever heard in my life is basically, if you hear about an investment from a Wall Street analyst, usually that means you're too late, okay? So basically, our big advantage as investors is that we can actually invest into companies before Wall Street finds out about them and institutions, and then basically push the price so high that it no longer makes sense. So we can actually go ahead, invest in companies before they get big, and then basically make a ton of money. That's the entire concept of this book also. Now, the second thing I actually learned is that Peter Lynch puts each investment he actually makes into 6 different categories, okay? So whenever he buys a stock, he tries to basically create a story for that stock and puts it in a category. And from there, he says, well, if this stock is here, where is the stock going to go? And on top of that, how much money can I potentially make by investing in the stock right here? Now, the categories are as follows. The first one is slow growers. Very large companies that don't really carry that much growth whatsoever, because basically it's very easy to get a 20% gain when you only have a few $1,000,000, but it's very hard to have that much gain when basically you have millions and millions of dollars. And you're basically a massive company, okay? And usually when you invest into large companies, it's going to be, hey, they have a solid dividend, and that's why I want to invest into them. The second category is the Stalward. Now these right here are big companies. By the way, I did not know how to spell this, so here it is right here also. But the Stalward is a category for large companies that have great fundamentals that actually survive during depression, recessions, or any market declines, or anything that actually goes on in the market. Okay, for example, Coca-Cola, Procter & Gamble, and even these days, Apple, and also, for example, Berkshire Hathaway. But that's not included into this category right here, but I just wanted to mention it. Basically, big companies with good fundamentals that basically don't carry that much volatility when the market does go down, but they're basically not growing either massively either. For example, like Coca-Cola, although it's not growing, the business itself is actually still improving, and that's the cool thing also about stalwart companies. And the third category is actually the fast growers, and these right here are usually small companies, because the smaller the company, the easier it is to have a lot of growth take place very quickly and very fast. And by the way, this right here also has its own categories. For example, small companies, fast growers go from being, for example, very risky in the beginning because basically you don't know what's going to happen, to then having more money to actually go out there and expand, to then becoming, for example, also slow growers as they actually get bigger and bigger and bigger. So the best part is you buy very early. When it's growing, that's when you make a lot of your money. And then when it starts to slow down, usually that's when you actually want to sell. There is so much information in this book. It's basically a wealth of investment fundamentals when it comes to investing. Great book, highly recommend it. Now, the fourth category of stock investments is actually cyclical companies. And by the way, very hard word for me to say, cyclical companies, okay? Or cyclical companies, which basically means companies that have, for example, times when they do very well and times when they do very bad. And your whole goal is to catch it during the times is actually going to do very well and sell it before times get actually very bad. For example, when it comes to car companies, okay, they tend to do very well when the economy is prospering. They have a lot of cars selling and all that stuff, but when times are actually hard, well, they have a lot more inventory and they're actually not selling that much. Well, during those cases, the company tends to lose a lot of money. So that's the entire point here. So basically, these companies during a certain period do very good, but during other periods will actually do very bad. So it's all about, hey, I want to catch it when it's about to go from, a bad period to actually going into a good period. A good example is, for example, a company that sells umbrella. During the rainy season, it sells a lot, but during the dry season, it doesn't sell that much. It's kind of like a cyclical company, a cycle company in a sense, but I don't know why he named it cyclical. I can't say that word till this day. Now, number 5 is turn around companies. And in my opinion, this right here is one of the most riskiest investment, because these investments right here are companies that basically are going bankrupt or have gone bankrupt, but then have changed something in the fundamentals to then go ahead and improve. So what you're doing is basically buying very low because everyone else is scared, but then you run the risk that, hey, what if the company goes bankrupt? Then you're screwed, and that's the entire point. So that's why you call them turnaround companies, and they require a lot of research because basically you don't want to buy a company that's going bankrupt and then you think things are going to change, but then before you know it, you lose all your money. So be very careful when it comes to turn around companies. In my opinion, very risky and not something that I would actually be interested in. And then lastly, number 6 here is asset play companies. A big example here is Berkshire Hathaway. It's a company that basically just holds a bunch of assets, a bunch of huge companies. But in reality, there are a lot of other companies out there that aren't Berkshire Hathaway, but actually have underlying assets that are actually worth more than the price you're actually going for in the stock market. For example, you have a company going, for example, for $10 per share, but the assets that actually hold and actually own can actually be worth around $13 per share. So every time you buy a stock, you're actually buying it with a $3 or 30% margin of safety. And that is the entire idea. So asset play companies are companies that own assets that basically are worth more than the going price in the market currently. But eventually, if the company goes bankrupt or whatever, you can sell those investments right there or the assets and then make your money back really quickly. Or when the stock market catches up, then boom, you actually make that money right there. That's the cool thing about asset play companies, and that's something that I'm actually interested in a ton. But guys, right then and there, Those are 6 categories that every time Peter Lynch finds a company, he puts it into one of those categories and then starts to make a story. Well, if this company is a turnaround company, well, what do they have to do correctly for the price to go up? But what can happen for the price to go down? Well, if this company is a fast grower, well, in what period are they right now? Are they actually growing right now, but it's very risky? Or are they expanding? Or for example, are they moving into a more slow growth rate because they're getting very big and competition is also coming up on them? So it's all about forming a story after you put the company into a category. By the way, this book, man, and its storytelling and a simplistic way to explain things did a very wonderful job. Now, the third thing I actually learned from Peter Lynch are 13 things to look for when you're actually wanting to buy a company. Now, I might not go through all 13 of them because basically it's a lot and it's also very simple to understand. So when you read the book, if you do, you'll get it and you understand exactly why this stuff is also so important. The first thing is, hey, if a company has a bad name or a boring name, usually that's a good sign because it means also, by the way, guys, the thing is you might say that doesn't matter, but in reality, Wall Street is filled with analysts, right? So whenever they're looking up companies to actually invest into and recommend, well, in reality, they want companies to stand out. And if it has a boring name, usually it might not stand out. And then that's your chance to go ahead and say, well, this company is dull, the name is dull, but I want to go ahead and invest into it because basically the assets, the whole company is actually a pretty good investment. So a bad name sometimes is a good sign that the company might actually be a good buy. On top of that, a dull business. The more boring the business actually is, the better the investment actually is also. Because what you're doing is basically going against the analyst because the analyst wants to basically sell something to the customer saying, hey, this company is so exciting, but they don't want to sell a company that basically all they do is, hey, they make toilet paper and they basically sell it. Oh my gosh, so exciting, right? That's the idea there. On top of that, something that's disagreeable. Tommy, what do you mean here? Well, this basically means a company that when people hear about it makes people want to turn away. For example, there was a company that did very, very well and almost tripled their earnings. And on top of that, tripled its stock price because basically they were actually into buying funeral homes, okay? And the idea was that you went inside the company and you actually bought your caskets and all of your, like, you know, all your stuff beforehand. And that way, guess what? You got a discount before the time actually came. And that's the whole idea. So when you hear that, usually it turns you away and you don't want to invest into the company, but usually that's also a good sign because the company was actually growing a ton. Until this day, there are a lot of companies out there that people kind of don't want to learn about, but they're also very important and also pretty good money-making opportunities. And also, if institutions don't know about it and haven't owned it yet, and analysts aren't talking about it, well, that might be a good sign also because what you want to do is be the early bird. You don't want to invest into something when everybody else knows about it, okay? You want to invest into something when basically, hey, no one knows about it just yet. It's not overcrowded, and not yet is it overpriced. And that's where you actually go ahead and you get the 10 baggers. And by the way, the 10 baggers are stocks that return 10x the money you actually put into it. You put in $100, you get back $1,000. And that's your goal when you're reading this book right here. And lastly, again, I can't go over all the 13 things you can actually look for when it comes to stock, but I highly recommend you read this book. But lastly here, that's what I'm gonna mention here, is basically, if the stock has a negative rumor around it, usually that's a good sign that it might actually be time to actually invest into it. Because sometimes, for example, a good example is that when it comes to the trash companies out there, and I didn't know this either, but the trash companies, like the waste management companies, are actually associated sometimes with the mob. So that's something, bad rumor, you might not want to invest into it, but in reality, it might mean it's actually a pretty good investment. Bad rumors, oh my God, this company sucks. For example, Wells Fargo, but is the company actually good? Although they did do something that's bad, well, in reality, it's all about checking the company out and seeing exactly where it actually stands financially. That's the cool thing. Sometimes a rumor can damage a company, but the company still actually performing good, then in reality, it's just a perfect time to go ahead and buy the stock for actually a lesser price. Now, the fourth thing are basically stocks that you actually want to avoid. And by the way, guys, this video is getting really long, and I actually wanted to give you guys a ton more stuff in this book, but I'm just not going to be able to. So the first time ever, I want you guys, I highly, highly recommend, if you want to invest, read this book. It's actually pretty great. And overall, guys, in the end here, the entire goal of this book was to show you exactly how you go out there and you analyze a stock, the story you have to create for it, and how to go out there, pick a stock, create a story for it, and see exactly when you're going to buy or basically when you're actually going to sell. And by the way, remember this, okay? Peter Lynch bought well over 1,000 stocks. You're going to buy a lot of stocks. Some of them are going to be winners, some of them are going to be losers. But the point is, if you're investing the correct way with the right fundamentals, losing is a part of the game. I understand that, but it does not mean it's actually the rule. So don't go out there and pick stocks because, hey, this one's pretty, this one's nice, this one's growing like crazy. The entire point is, hey, what is this company doing? What is the story? What's the balance sheet? What's the cash flow? What's the debt to equity ratio? Hey, what is this actual company book value? Okay, it's all about understanding the fundamentals of a company and how to analyze it at its core, and then going ahead and investing into the company. Although I say, hey, this book is about creating stories for stocks. Yes, it is, right? But it's also about the numbers and also understanding the core business of it. And for that, you're going to need accounting skills. You're also going to need some finance skills to project into the future. And that's the entire idea here. And these are all skills you can learn in books, or for example, going onto Udemy or Skillshare, whatever app there's actually out there, and just going ahead and studying some accounting skills, or for example, some finance skills for a very cheap price, and not having to go to Columbia and paying, for example, $100K for a degree every single year. It's crazy, okay? But all this stuff you can basically learn it on YouTube or for free out there. So do not feel like, hey, it's not possible for me. The answer is yes, it's very possible for you. So go ahead, get this book, highly recommend it. Comment down below, let me know what is your favorite book of all time when it comes to money. Let me know, that way I'll read it, give you a shout out if I read your book also. And I'll see you guys next time. If you like this video right here, well, like this video on top of that also. And on top of that also, subscribe and hit the bell so you're notified when I post a new video. And before I go, if you want to text me or talk to me, so to my Patreon, link down below, or send me a DM on Instagram at TommyBryson. And if you want to see my portfolio and what I invest into and the dividends I actually get, here's that video right here. And on top of that also, so see you tomorrow. Thanks for watching, and as always,